In our final lesson, we will complete our study of personal financial management. We'll take a look at home ownership. We'll discuss fixed rate mortgages. We'll also look at the impact that taxes, insurance, and maintenance have on your monthly financial responsibilities. A loan for a substantial amount extending over a lengthy time interval, either 15, 20, 25, or 30 years, for the purpose of buying a home or other property or real estate, and for which the property is pledged as security for the loan, is called a mortgage. Other terms for mortgages are deeds of trust and security deeds. The time until the final payoff is called the term of the mortgage. The portion of the purchase price of the home which the buyer pays initially is called the down payment. In order to calculate the principal amount of the mortgage, simply subtract the down payment from the purchase price. With a fixed rate mortgage, the interest rate will remain constant throughout the term. The initial principal balance, along with any interest payments, are repaid to the lender through regular, periodic payments. In most cases, these are monthly payments. This is called amortizing the loan. Although we will not be discussing them, please be aware that there are also adjustable rate mortgages, or ARMs. In this type of mortgage, after an initial period of time, your rate, and consequently your payments, are adjusted accordingly in accordance with current economic conditions. In a fixed rate mortgage, we can calculate the regular monthly payment with this formula. Let's look at some of the variables. R represents the regular monthly payment. P represents the amount that you're financing, or the principal of the mortgage. R is our usual annual rate. T, once again, is the term, which is in years. If you look at the bottom of the page here, you will see a calculator-friendly form for this formula. Let's find the monthly payment necessary to amortize an $80,000 mortgage at 6% annual interest for 25 years. Let's use our calculators and this formula. We'll replace P with 80,000. Make sure you have the proper number of zeros. Make sure you change 6% to 0.06. Being careful to use all the parentheses as indicated, see if you can get this monthly payment. It should be $515.44. We can also use a mortgage table to find the monthly payment. There is one in your text. A 25-year, 6% mortgage will have a monthly payment for a loan of $1,000, which is 6.44301. Since we are actually borrowing $80,000, we'll multiply that 6.44301 by 80 to once again verify that our monthly payment is $515.44. Once we determine the regular monthly payment, we can create an amortization schedule. Now these are usually computer generated, but it's still important for you to understand how the values are determined. We'll use the information from our last example, $80,000 financed at 6%, and we'll complete the table knowing that the monthly payment is $515.44. Remember, in a fixed rate mortgage, your monthly payment will not change throughout the term of the mortgage. Before we make payment 1, our balance is $80,000. Let's calculate the simple interest on $80,000 at 6% for 1 month. $80,000 times 6% will give you $4,800. Divide that by 12 because we only want 1 month's worth of interest, and you'll see that our interest payment is $400. Because our total monthly payment is $515.44, once we subtract the $400 interest that we owe, we have a balance of $115.44, which actually gets applied to our balance. At the end of the first month, we now owe $79,884.56. To complete the second month, we'll begin with the $79,884.56. Take 6% of that, and once again divide by 12 because we're only interested in 1 month's interest. This time you find that the interest is $399.42. Your monthly payment is still $515.44. So the amount that you'll be applying towards your principal this month is $116.02. Let's make a couple of observations here. Notice that the total of your interest payment plus your principal payment will always equal $515.44. Also notice that the interest payments steadily get smaller. That's because interest is calculated on your balance, which is continually being lowered. Also notice that your principal payments will continue to rise. Take a look at some examples in your text to see the last few payments of an amortization schedule. In addition to monthly payments, homeowners also have several things to consider. They have to be able to accumulate the down payment first. They have to have sufficient cash and income to qualify for that mortgage. And of course, they do have the mortgage payments to deal with. In addition to the monthly mortgage payments, property taxes are collected by county or local governments. Property taxes and your mortgage interest are deductible on your income taxes. If you hold a mortgage on your home, you must have homeowners insurance. It will cover losses due to fire, damage, and other casualties. Homes also require maintenance, but these costs definitely vary greatly. A couple has a 25-year, $175,000 fixed-rate loan at 7%. In addition, they owe $2,800 in annual taxes and $750 annually for homeowners insurance. What is their net average monthly expenditure? First, you want to determine what the monthly mortgage payment is. You can either use the formula or use a table. Their monthly payment is $1,236.86. This is strictly to pay off the mortgage. They also need to consider that they have additional expenses from taxes and insurance. We owe $2,800 in annual taxes and $750 in annual insurance premiums. Add those two extra expenses and divide by 12 to get the additional monthly obligation. This will give a grand total of an average net monthly expense of $1,532.69. Let's take a moment to look at financial investments. Stocks, bonds, mutual funds, and we want to evaluate investment returns in order to better build a nest egg. When you buy stock in a corporation, it makes you a part owner of the corporation. You are then entitled to share in any profits the company makes, and your share of those profits is the dividend. If you sell your stock for more than you paid, you need to declare a capital gain. If unfortunately you sell your stock for less than you paid, Then you have a capital loss. When we talk about return on investment, we mean the net difference between what you receive, including any dividends, and what you paid, which would be your purchase price plus any other expenses of buying and selling the stock. The price of a share of stock is determined by the law of supply and demand at the stock exchange. Let's take a look at an example of return on stock. Let's say you buy 100 shares of stock in Company X on February 2nd, 2006. You pay $28.50 per share. On February 2nd, 2007, you received a dividend of 60 cents per share on the stock, and the price had risen to $29.75 per share. Let's take a look at some of the calculations. First, we'll look at the total cost for the stock. The purchase price was $28.50 times 100 shares means our total cost was $2,850. Next, we want to look at the total dividend amount. Company X paid out 60 cents per share times 100 shares. That means our total dividend was $60. If we actually sell the stock on February 2nd, 2007, the price had risen to $29.75 per share. 100 shares would yield us $29.75 minus the $28.50 that we paid, means our capital gain would be $125. The total return and percentage for 1 year investment would be calculated by adding our dividend plus our capital gain. The total return was $185 for the year. It's also important to look at the percentage return for this. In order to calculate the percentage return, we need to take our total return, which was $185, and divide it by $28.50, which is our total cost for the stock. Multiply by 100 to convert it to 6.5% percentage return. Reading a stock table. The first column talks about a year-to-date percent change. When we look at the year-to-date percent change, we're talking about this calendar year. So if you're looking at this stock table on January 15th, there's not a lot of information to gain from this. However, if you're looking at December 15th, you have a long period of time to see what percent the change was. In this example, the stock increased 3.5% for the calendar year. When we move into the next two columns, we're talking about the 52-week high and low. This will give you an entire year regardless of what point of the calendar year we're at. For this example, the low was $12.66 a share and the high was $19.55 during the last 52 weeks. The next column is simply the stock itself, and then in bold letters we have the symbol as it's listed on the stock exchange. The next three columns give us some information about the yield. This tells us that this company pays 53 cents as an annual dividend. It represents 2.8% as the yield of the price of the stock. And 35 is the price to earnings ratio, which is the stock price divided by earnings per share over the last 12 months. When we look at the volume column, this is telling us volume in hundreds. So I would take this number and multiply it by 100 to find out that 141,100 shares were sold on that particular day. Close represents the closing price, and the net change gives us the change over the closing price the previous trading day. If a line is listed in boldface, it distinguishes it as a stock whose price changed by 5% or more. An underlined row indicates a stock with an especially high volume of trading relative to its usual volume. A PF between the company name and symbol indicates a preferred stock. This is a special category in addition to their ordinary or common stock. A company must pay dividends to the holders of preferred stock before it can pay dividends to holders of its common stock. An up arrow at the left indicates a new 52-week high, while a down arrow indicates a new 52-week low. To buy or sell a stock, generally it's necessary to use a broker. A broker has representatives at the stock exchange who will execute buy and sell orders. The broker will charge a commission. Full-service brokers offer research, professional opinions, and other services, charge the highest commissions. Discount brokers buy and sell stocks for clients, but offer little in the way of additional services. Commissions will normally be some percentage of the value of the purchase or sale, called the principal. Rates may depend on whether the order is for a round lot, which are shares in multiples of 100, or an odd lot. In an odd lot portion, you may be charged an odd lot differential. Also, it's possible to place a limit order, where the broker is instructed to automatically buy or sell if the stock reaches a pre-designated price. We'll take a look at a commission structure in the next two slides. Here is an example of a broker-assisted trade. Notice that the commission is based on the principal amount, and then there's also a percentage charge of the principal. In an automated trade, you might just have a flat commission for shares up to 1,000, and then more than 1,000 shares would charge a per share fee. Let's find the total cost for a broker-assisted purchase of 800 shares of a stock at $5.45 per share. Our basic cost is $4,360. That would be $5.45 times the 800. Our broker commission we can calculate from the previous table. Here is where our principal amount lies within this range, so we know that our commission is $65 plus 0.66% of the principal. So here's our $65. 0.66% of the principal, we must change to 0.0066 to calculate this. Our principal was $43.60. Our total commission is $93.78. So our total cost for this sale is $44.5378. You need to keep in mind all of these costs when you're trying to calculate percent of return. Bonds are different in the fact that you're actually lending money to a company. You receive an agreed upon rate of interest for the use of your money. The bond is issued with a stated term, after which the bond return matures and your principal is paid back to you. $5,000 is invested in a 10-year corporate bond which pays 7.5% annual interest paid semi-annually. Find the total return on the investment if it is held to maturity. We use simple interest in this case. $5,000 times 0.075 times 10 gives us $37.50. A mutual fund is a pool of money collected by an investment company from individuals or institutions and then invested in many stocks, bonds, or money market instruments. Some of the advantages of mutual funds are simplicity, diversification, access to new issues, economies of the sale, because expenses are shared by a large number of investors, it makes it better for you, professional management, and finally, indexing. Some disadvantages of mutual funds include the impact of one-time charges and recurring fees. There are usually hidden costs of brokerage. There are hidden risks of fund ownership. It's important to be able to accurately evaluate and compare returns, whether they be profits or losses. Remember that past performance is never a guarantee of future returns. However, it's something that you still want to look at. There's a wealth of information on stock and bond markets and mutual funds through publications and internet resources. Please read any information that you obtain from the companies themselves very carefully. And finally, remember the most important measure of an investment is the annual rate of return. It's not the same as the percentage return because you need to understand how long the investment lasted. It's the annual rate of return that we're interested in.